Since that surge in gold, the miners, and silver that occurred in 2020, where we peaked in the summer of 2020 in that big surge, uh, the miners and silver did better than gold in that surge. But since then, between 2020 and recent lows, the miners and silver, while they've gone up in price nicely, they've gone up a lot less than gold. So they've underperformed gold. Okay. Not like they're a bad place to be. It's just that they haven't matched the mama market. The technical evidence now is that when we monitor it, those spread relationships between silver and the gold and silver miners versus gold is shifting, favoring them as opposed to gold. So if you'll look at just a simple price chart, which we look at secondarily, but in April, gold was where it is now, sideways, up, down, but no real drops, just a sideways, dull situation. By the way, gold never, ever tops that way. It doesn't top with a quiet top. It tops with this peak and a collapse, okay? But anyway, so gold's gone sideways, cooling off. Silver's gone up during that time, especially the last 2, 3 months. Miners, if you look at them, their behavior is quite independent of gold now. There'll be some days you'll have gold flat or down and they'll be up, which is highly unusual. And it's showing that some investors are starting to move money already into the miners, probably large portfolio managers who are maybe a little less enthused about the stock market nipping out a new high than the average guy is. And they're looking for alternative places to put the portfolios. And normally, if you go back and look at 2000 to 2002 bear market stocks, 2007 to 2009, during those times, there were two alternatives, gold and T-bonds. T-bonds are no longer an alternative. So you're left with really one alternative, monetary metals. And T-bonds, in fact, could become like a hand grenade thrown into a small room here, the way they're behaving right now, because they're acting like they could. You drop bonds right now, the T-bond futures, 30-year bonds, are trading in the 113, 112. No, excuse me, near 112 right now. Okay. You get down around 110 again, which we've been before in recent months. You get down around 110, another couple of points, no big deal. It could start to implode in a way that causes the central bank and the central government to panic. Yeah, it's not one of the Fed's mandates, the inflation, quote unquote, and the job market, the economy. The federal debt is not one of their mandates, but it has to be because it's a time bomb and it's huge. And so you start to throw that guy off the cliff. One, it eliminates the alternative that always is there for paper for money to move to, but it also panics the central bank into having to do something monetarily wise, whether it's one of their mandates or not. They have to save that market because it's their debt market. It's not somebody else's mortgage like in 2007. So we got real interesting times here. And I think it's like it's compressing to the point where it could get volatile and violent quickly. Yeah, in fact, gold hasn't gone up for 4 months. And look what GDX has done. Look what SIL has done. So the silver miners ETF, they've gone straight up. So the spread is moving in their favor. And frankly, if I were to throw out a ballpark number, at minimum, silver is likely in this surge. Right now, it got under 1% of the price of gold. In other words, you divide an ounce of silver into gold, it was less than 1% of an ounce of gold. It's now up to like 1.1, 1.14, something like that percent. It could easily go to 2% plus in a heartbeat. 2%, you divide an ounce of silver into an ounce of gold, has occurred 20 plus years in the past 50, meaning it's hardly abnormal to see silver at 2%. You don't even have to have dynamic market for it to be at 2%. And if you just went to 2%, that means silver doubles in relative value to gold, I think, by the end of the year. Wouldn't shock me. Well, it's, would you rather be in something that doubles, compared to the other or not? Okay, miners, Not necessarily in the next, by this year, end of the year, but over the next year or so, I could see them tripling in relative value to gold. Now let's talk about gold. What's reasonable for gold here? And I've said this in quite a few interviews. If you go back 50 years and look at the 1980 bull peak, it was an eightfold move from its prior bear low. Then go from 2000, 2001 lows, which was around $260 gold, to the 2011 high at 1920 was another eightfold move on a ratio scale. Well, our low was 1,050 in 2015. That means $8,000, $9,000 just to match two prior bull market peaks. And this time, I argue, we have massively more dangerous, implosive, and explosive factors underway in all markets around the world. Government debt market, US stock market, far more massive situations with wave effects that should be more powerful even than those bull markets. And another thing I tell people is I don't think gold's going to go up and make a peak and collapse again. I think when gold makes its next quote peak or goes to another stratospheric level, it could be money again. Meaning that's it. You know, this government, that government, that government, suddenly, all of a sudden, gold is money again, legitimate. And gosh knows what price gold might be when that occurs, which case it's institutionalized. So it's different this time. It's far different, more dynamic, and the outcome's going to be different. Yeah. The ratio between silver and gold, yes, that is a technical factor. I'm not going to try to explain why does it do this or that. A lot of people like to have a reason. There are many reasons. The main reason driving silver and gold over the long term is the ongoing degradation in money, meaning the real value of fiat currencies degrading and degrading and degrading. So gold goes up because it's money. Okay. It's really not going up. It's just all those money units are going down in the real value. Okay. What else did you say about the?
The
Oh yeah, COT report. Yeah,
Yes.
that's one of my favorite things to ignore. Okay. I know a lot of people like to find something short term that causes them to be fearful or not be fearful. And a commitment of traders report showed a couple weeks ago, I think it was, I had two subscribers send me an email asking me, "Are you concerned about this?" And it showed that institutional or commercial, excuse me, commercial side of the market was more heavily short than it's been in a long time. I didn't pay a lot of attention to, compared to when and when. And I said, I don't care about that. There's a couple reasons I don't. But first off, commercials normally are because they produce the product. Therefore, if they're short, they also may own the bullion coming out of their minds. And it could very well be that, let's say, over the last year, a lot of them simply, it's a subjective decision, remember. The miner doesn't have to hedge, or he can hedge to whatever degree he wishes. It's a corporate decision. A lot of these miners may have simply said, hey, man, silver's going up, and I kind of want to let it go because I want to make some money. I don't want to lock in a low price, when I might make a lot more by letting it run and not hedge it. So maybe they rode the last year up only 50% hedge, let's say, because they sort of collectively thought, hey, I'm going to make some money. And they did. Okay. But then silver got up to 37 or so, a few weeks ago. Now it's 38, 39. And it paused for a while. Maybe they decided then, let's hedge here. And so suddenly you had a shift from less hedged to more hedged, and that caused that number to jump. And another opinion of mine is, and I learned this a long time ago when I got into business, 1975, I got hired by E.F. Hutton, commodity division in New York, the headquarters. And chairman of the COMEX was also the head of Hutton's commodity department. And I apprenticed under him. I didn't know anything about technical analysis. And back then, I was sitting at the metals desk at Hutton, which was primarily a trading desk for copper miners that would hedge through Hutton. Okay. And a copper miner came in, a corporate CEO of a company that underwent almost bankruptcy in the prior year, I think it was, where he had decided, he, the head of the company, had decided not only to hedge, but to go short. So to have more than a short hedge position in copper because he thought it was just too high priced and ridiculous and so forth, thought he could make some money. It almost took his company under because there was a spike at the tail end of that bull trend where because of him primarily, he sat down next to me waiting for to talk to the head of the department and said, I created that spike, me covering shorts to keep my company from going under because he was overly hedged. And and which I remembered. And so when these people sent me that COT report information a week ago, I recalled that meeting, that meeting with that guy, and realized, sometimes people in the industry aren't necessarily smarter than the average guy. They're human beings. They may know how to get copper out of the ground and how to refine it, but they don't necessarily know about market trends and how to analyze them. And so the fact that they might be more heavily short doesn't prove anything to me about what's going to happen to the market. They're not always right. Okay. Anyway, enough said. Well, this is a very unique time. Uh, I personally own only monetary metals, nothing else. Like I'm bearish on the stock market, but I don't care if it goes down big or not. I'm not going to short it because its decline in percent terms is not going to compare to what silver's likely to do. I think silver's going to go to 60 to 70 this year. Okay. Meaning double basically from here. Uh, and beyond that, it may go to a couple $100 and beyond that. But I'm focused on the rest of this year, and it looks to me like the dynamic places to be will be miners and silver. But if I were a broader portfolio manager, I would be looking at stocks within the stock market that really don't correlate to the trends of the stock market, such as commodity stocks, grain related, agricultural related, uranium related, base metal miners, copper miners, and energy. I would watch crude oil very closely because it has suddenly become over the last, let's say, handful of months, the weaker among the commodities. Remember, it had a plunge back in April where you had a floor for 2 years on oil at $65, West Texas Intermediate, and you blew through that floor to the downside and went to like 55 in a panic. And we argued in our reports that's a bear trap. Don't believe it's going to sustain. It's going to flip back up. Well, sure enough, it did. And right now we're trading back above the 65 level, like back above that broken floor. Like, it shouldn't have happened. Okay. But you get up to 70 and close any month out in this quarter at $70 or higher. And like I said, that's $4 or $5 above we are right now. It's breaking out on long-term momentum. I mean, look at a price chart, getting back to 70 doesn't really break out over anything. But from momentum it does, and momentum usually leads price, and it says you're breaking out, boy. And I think at that point, oil could really start to surge again. And of course, what would that do? It would create panic because a lot of the people that voted for Trump, who don't normally vote Republican, blue collar folks, thought, hey, this guy can understands the real world and he's going to keep my gasoline prices down. I was one of his main things. Well, right now it looks like he's succeeded, right? Well, I'm telling you, the technicals argue that it could blow up big in a way that suddenly your gasoline prices go up by 30% quickly, like in a period of several months, once oil gets over that 70 level. And that will do a couple things. One, it'll hurt the average guy in the street because when he pumps that gas, he's watching that thing click, click, click. And that brings home to him the assumption that, wait, I thought this wasn't going to happen, which creates what? Uncertainty, okay? What he thought was certain wasn't right. And it's also going to, upend one of Trump's promises beyond his control. This was going to happen anyway. And when you do that, all of a sudden, when uncertainty prevails, based on real world things like price of gasoline went up 30%. Oh, that hurts, have to actually watch how much I put in, et cetera, et cetera. That creates emotion and panic. And all that combined impacts the real world in terms of what's going to happen next, what institutions are in jeopardy. I think when the stuff hits the fan here, and a rollover in the stock market will create your bad job numbers, by the way, and then the Fed will have to panic. Remember 2007 through 9, the average guy wasn't in the stock market, got laid off. He suffered big time. It'll be that way this time too. In fact, it's already occurring in reality if you look at the job numbers. It's mainly government jobs. Uh, anyway, we're facing a very dramatic reality, and I think it's going to not happen incrementally. I think it's going to
Yeah.
be like all of a sudden. Listen to your granddad, because he's probably the one who said something good about gold. Okay. The reality is, if from an investment time perspective, meaning decades or 10 years at a time, go back 3 or 4 years, gold's beating the S&P. Who would think that? Go back 10 years to the 2015 period when gold was making a low. Also, the stock market was having a pullback then. Gold's beating the S&P since then, 10 years, beating it from a year ago. You go back 25 years, summer of 2000. Gold is up 11-fold. S&P's up triple. Okay? All you have to do is just get dumb. Sometimes don't have to be nitpicking. Gold is real money. It holds its value when governments degrade the thing in your pocket. Yeah, just because something's going up also doesn't mean you're making money. Because we put out a chart that's laughable of the Venezuelan stock market. Just a price chart on the first page of one of our reports a month or so ago. And it's just this upward curving beast exploding off the page. Lovely looking thing. And we said, hey, why aren't you long the Venezuelan stock market? And of course, everybody knows, well, that's because they're destroying their money unit, and it's just reflecting the degradation in the piece of paper. So is a loaf of bread down there. It's probably doing even better. Same is going on here, just to a lesser extent. Our money supply grows almost double every decade. Lately, more than that. That means that if you bought a stock for $10 and 10 years later it's 20, you're not really making money in terms of the spending power of that money. Yeah, it's an on paper profit. And you've got to factor that into reality. And that's why gold went up 11-fold of 25 years, and the stock market went up triple or so. Where do you want to be? One of your pillars should be, I want to be in real money. So when you buy gold, you're really not investing. You're putting it in money that doesn't degrade. Simple as that. It's like a savings account. It's not a speculative thing. Uh, and then I would look at, from time to time, you have to reassess reality. And right now, our assessment is certain undervalued assets are worth having, and probably for the next couple of years. And that would be commodities. And again, we have a condition on that Bloomberg, which is now just below 104, I need to close a month out above 106.52 to put a precise number on it. You do that, it's launch city. Commodities in general will start to advance strongly because they're still dirt cheap, historically speaking. And so that would be a place to be, probably for the next couple of years. Commodity related assets, stocks, so forth. Not government debt. Government debt's not safe, and probably for a good while it ain't going to be safe. And it could get very dangerous in the short haul. Panic city, which creates wave effects in other markets, uh, negative wave effects. So I would stress right now, gold is an ongoing percent of your portfolio, gold related, and right now it would be the miners and commodity related stocks, and then be open over time as things change to other potentials, not general stock market.
Thank you very much, Michael. It's a very detailed answer. So those are all the
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. with Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.